Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May, and this is Getting Started with Technical Analysis. This webcast series is all about charting, using stock charts. And when a trader is using a stock chart and they're applying all of their skills, all of their tools as they look at that chart, what are they really trying to do? Well, very likely, they're just trying to identify price lows and price highs on a stock chart. Yeah, so this webcast is going to be all about looking for lows and highs on a chart. We're going to be giving 5 potential ways that a trader might identify support and resistance. Big questions to address today, so I'm looking forward to it. Before we get to that, let me first of all say hello to everybody that's already chatting out there in YouTube. Great to see AJ, Harry, Life in the Fast Lane, Greg, Naresh, Manuel, Mary, Larry, Scott, Joe, Kathy, Frank, Kevin, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation as you watch that recording. But be aware that you're invited to join us in a live discussion. If you'd like to be here live, we kick things off right at 2 o'clock Eastern Standard Time on Tuesday afternoons. And then as a final heads up, my very good friend Lee Bohl is going to be hanging out in the chats with us. He's going to be addressing any questions that I can't get to. As long as they're on topic, Lee's there to pick up the slack. Great to have you here with us, Lee. Thanks for being there. But Lee and I would also like to issue an invitation to, if you're not following us on X or on Twitter, please do. It doesn't cost anything to follow us there. It's a great resource. It's the best place to connect with your favorite presenters in between these live streams. So you can find Lee at Lee Bohl CS on X. You can also find me there at Cameron May CS. All right, but let's get into it. As we dive in, we need to bear in mind that risk is real. These are important reminders. Just remember that any investment decision you make in your self-directed account is solely your responsibility. Having success with your paper money account is not a guarantee that you're going to have success with your real funds, as market conditions do change and they can change rapidly. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so with that accomplished, let's set an agenda for the day. Just a few items on the agenda. I think it's going to be a fairly straightforward discussion. The first thing we want to do is talk about the potential identification of support and resistance levels on a price chart. So I do want to lay the groundwork for those that might not be familiar with the concepts of support and resistance. So I want to go through a quick definition of those terms first. Then we're going to go to some stock charts and start to identify potential support and resistance areas on that chart. And we're going to apply 5 different techniques that might be used in the identification of price lows and price highs, or support and resistance. And then we're going to go through a series of charts to get some repetition with the application of the concepts that we've just learned. So it's not just going to be about theory here. We want to make sure that we're actually using the Thinkorswim platform to show how we might apply this new knowledge that we've gained. All right, so there we go. Let's go right to it. And let's first of all set the foundation for the discussion just with addressing the terms that we're using, the terminology. So in my teaser here, you notice I made reference to the terms support and resistance. Well, support is simply a trader phrase for a price floor. Resistance is trader speak for a price ceiling. So we refer to a price floor, such as what we've seen historically on AVGO. So for example, if we look back here from this period from June almost to 2024, really a long stretch of 6 or 7 months, you can see that prices just refused to go down below about $800. It's as though there was an invisible force supporting things from below. So we refer to that as support. At least that's the way that I think about it. Now, at the same time, prices just kind of refuse to go higher than about $920, occasionally slipping a little bit above that, maybe a few dollars above $920, but then rapidly retreating from that level. It's as though there is a compressive force coming down and resisting any further advance in price. So we think of price ceilings as resistance, price floors as support. If you'll forgive me, I'm going to be using that terminology all the way through. So just be aware that we use these terms interchangeably. Price floors, price lows, price support. Okay, price ceilings, price highs, price resistance. Okay, so let's talk about our first potential technique or way that a trader might look at a chart and identify for themselves where they think price floors and price ceilings might be. And once those have been identified, well, that might make that chart quite tradable if those levels prove to be accurate into the future, right? But when I really think about a brand new rookie trader, they've never used a price chart before. They probably, even before they bring up their first chart, they may have a concept in their mind. I know what I intend to do. I just want to find a stock that's just been going back and forth between two price levels on a horizontal plane. Maybe it's $40 on the low side, maybe it's $50 on the high side, but looking for a stock that's just been going back and forth between these horizontal levels. And the next time it gets back down to those lows, I intend to buy or enter into, let's say, a new long stock position. And if it rallies up to those highs, I intend to sell. You know, that's a pretty straightforward, simple, basic concept. Is it one that might actually be conceptually applied to a chart? Yes. As a matter of fact, that is precisely the technique that some traders employ, and they may employ that technique exclusively. Now, this webcast series, we explore all sorts of indicators and techniques. We get pretty fancy with things. Doesn't always have to be fancy. For example, I think one could imagine someone looking back historically on AVGO, on Broadcom, and noting, let's put ourselves in the shoes of a trader back here, maybe looking at AVGO in August. And they note, wow, in recent weeks and months, the price has been as high as above $900. And here we find ourselves, maybe looking at this in mid-August, we're down closer to $800, maybe down to about $810. We look at that $810 level, we look back and we say, well, back in June, it was down around $810, and then it went up over $100. Back in May, it was down around $800, and it was above $900 in a relative heartbeat. What if it does this just one more time? Maybe we could buy right now at $800, $810 and see if we could rally again up above 900, maybe take some profits at that point. Yeah, I think that it's quite likely, certainly not a guarantee, but quite likely that there were traders that were looking through precisely that lens. And if they executed that plan, that very straightforward, pretty simple plan, could that have been profitable? Yep. So this is one of those ways that traders might plan a trade using identified areas of support and resistance, price floors and price ceilings. What they're doing here is just looking for horizontal price levels and using those for planning for floors and ceilings, support and resistance. Now, that is fairly straightforward, but there are a couple of points I want to make on this topic, and that is what you may notice if we scrutinize this a little bit closer. It's tempting to say, well, looks like the floor is $800 and the ceiling is $900, just for simplicity's sake, maybe do a little bit of rounding, and that might be serviceable. But actually, in the identification of floors and ceilings, and this is going to apply to all 5 of our techniques, very rarely is it a very precise level. Instead, traders will commonly talk about ranges of support and ranges of resistance. Here's what I'm talking about. As price pulled down here on Broadcom, you'll notice in June, the lows didn't get down to my drawn line down here. They got close, but that low is actually $818.85. As I point at that candle, if you look up here at the L, that's the low for that day. And you can see, didn't get down to 800, didn't get down to 810. It actually got down to 818 and change. So on a percentage basis, pretty close, but not exactly where the trader might have been anticipating a floor. Then as we rally up, we might have in our minds maybe $900, maybe $920. But you'll see that we got a series of touches up here. The first one, we got up to a high of $913. The second, you'll see this white candle here, we got up to $923. This third white candle only reached $920. So all are in the same area or a fairly narrow range of prices, but not it's not that the stock is sagging down to, let's say, $812.42 every time, and then rallying up to $922.19. Using that level of precision may be overstating the potential application of support and resistance, the potential value of support and resistance levels. Okay, so instead, what the trader may do is round significantly. So instead of saying, well, since we were down here to 918.85 last time, rather than planning to get in at $918.85, maybe the trader might be satisfied if we just get down to, let's say, 920, close enough, right? So yes, it's or 820, I should say. But that's one concept that a trader should likely bear in mind as they're looking for areas of support and resistance. A second concept is that the more touches the trader sees on a stock chart at what they anticipate to be an area of support or resistance, the more significant that is typically seen as being. So, for example, the very first time we got down to around $820, the trader might say, well, that's nice, but it's really, it's only been to this level maybe once or twice in the past. There hasn't really been a pattern established just yet. The next time we sell off and we find ourselves in a similar area or range, well, this might actually be increasing the trader's confidence that they've identified something significant. We rally up, we pull back, and now we find ourselves a third time. And actually here, we had a whole series of touches right around that $800 to $820 level. Yeah, here, the trader may start to feel quite confident that another rally seems imminent. Of course, still not a guarantee. Just because we're confident doesn't mean it's absolutely going to happen. So here we can see a series of touches in that same area, one here, two there, really a whole cluster of them here, and then a fourth there. Pretty solid area of support in technical terms, and similarly, a pretty solid area of resistance for Broadcom up here around that 920 range. All right, so identifying support and resistance on a horizontal plane, possibly the most basic, but still potentially quite actionable approach to trading stocks using stock charts. So that's technique number one. Now, technique number two is that the support and resistance areas don't always present themselves precisely horizontally as they have done here on AVGO in this case, and more recently up here at these higher levels. Sometimes the identification of support and resistance will be on a diagonally ascending plane. Now, everything that we're doing today is going to be framed within a bullish context. We're not really talking about bearish trades, but the same concepts might just be flipped on their heads and used for structuring bearish strategies. But let's have a look at something like Microsoft. Okay. Here's Microsoft. Yes, there are times when it chops sideways, hitting similar highs and similar lows, establishing potentially horizontal areas of support and resistance. But in this case, what the trader might note is that from September until, about April of this year, rather than going sideways, Microsoft was moving up a ramp, making higher highs and higher lows, right? And when a trader sees that sort of a price pattern behavior developing on a chart, they may look at these lows that are being established on the chart and connect those with a line. And you can see it sort of establishes that ramp that may act as a serviceable price floor and help with the planning of new trades. Now, similarly, if they're trying to determine, well, if we're down at a price floor, where might the next price ceiling be? Well, they may project up along a trend line drawn across the top of those highs. So connecting the highs to establish a price ceiling or resistance, connecting the lows to establish a price floor is a pretty common practice in technical analysis. And both of these obviously require some discretion in the identification of these highs and lows, right? So these techniques are techniques that traders will typically perform if they feel comparatively comfortable and confident in bringing their own expertise to a chart and applying their own discretion. There's, of course, pressure that comes with that, but With the potential for gains, there's always the potential for loss, and the self-directed investor shoulders the responsibility for both of those. Okay, but just be aware that sometimes, yeah, the trader is looking for, rather than horizontal areas of support and resistance, diagonally ascending areas of support and resistance. But the same concepts apply to the diagonal support and resistance, or price floors and ceilings, that apply to the horizontal. And those are, rather than looking for precision, we're looking for areas or ranges. So for example, we ran up here and then pulled back, maybe didn't exactly touch this diagonal trend line, but we got close here. We got close there. There were a couple of more precise touches right here and some more right there. With the resistance, pretty good cluster of touches right across this range, pretty good cluster of touches right there. Came up a little bit shy here, and you'll notice even with this example, there's an example of where price actually got up and through that anticipated price ceiling temporarily. That's not uncommon at all in the drawing of support and resistance areas, trimming off some of the extreme tops, coming up a little bit above some of those that didn't get quite as high, just sort of looking for an average to represent the middle of an expected range or area of support or resistance. Okay, so there are two techniques: horizontal, previous highs and lows; diagonal, previous highs and lows. Now, a third thing that a trader might look for, if they're not terribly comfortable applying their own expertise, going with a manual approach, some traders actually look for technical indicators to potentially identify price floors and price ceilings. And one that's quite commonly used is something known as a moving average. Okay, so I'm going to come up here to our little beaker icon, and I'm going to apply a moving average. Now I'm going to hit the pause button on that thought for just a moment, because I just glanced over here at the chats. I've been saying hello to everybody before the webcast launched. Great to see all of my familiar repeat attendees here. But I also noticed that a link has been added for the benefit of the live stream attendees to give some feedback via a very short survey. If you've never filled out one of our surveys before, it's just 2 multiple choice questions, a comments box and a suggestion box. So comments and suggestion, obviously optional. You could just go in and make your selection regarding the multiple choice questions and be done very quickly. Or those comments or suggestions are also very much appreciated. What I will say is that if you take the time to fill out one of our surveys, I'll take the time to read through that data, and I read through the comments. Definitely, it always helps. Okay, so thanks for doing that for me. Off my soapbox for the sales pitch for the surveys, let's get back to talking about identifying price floors and ceilings. All right, but yeah, sometimes a trader will shift to their preferences to, rather than applying their own analysis to a chart, they might prefer to use a technical indicator. And the indicator that I'm going to use today for the identification of potential support and resistance is known as a simple moving average. So I'm going to click on the little beaker icon. We have a whole menu of potential indicators, and the one that I'm looking for is the simple moving average. We could just go down in alphabetical order, or we can do a keyword search. Either way, let's find that. I'm going to add that to our chart. And the default moving average here is a 9-day moving average. I'm going to customize that for this example. Let's click on the little gear icon. And let's say the trader is looking for, the usage of a little bit more data than just 9 days. Let's use a length of 50 days. I'm going to click OK, click Apply, and click OK again. And I'm going to remove my drawing. Right-click here. Let's remove that drawing, so that we can just look at this indicator that's been added to the chart. So if you're not familiar with a simple moving average, this is how it's constructed. Okay, you'll notice there's a number over here to the far right, 413.93, that lines up pretty nicely with the current value of this moving average. What this is telling us is that over the last 50 days, since I chose 50, it's looking back over the last 50 days, and telling me that the average closing price of Microsoft has been $413.93. So right now you can see today's price is below the average for the last 50 days. And we can see that over time, that average price changes. Our price chops around, but the average changes direction more slowly. For some traders, they see this as a maybe a clearer view of, let's say, quote unquote, a more accurate view of trend. Obviously, only time tells us whether that proves to be accurate or not. But this can be an indication of trend if that average price is increasing over time, if it's moving higher. But also, our moving average can frequently act as support. It can also act as resistance, price floors, and price ceilings. So why might it do that? Look at this period right here where price shot up, got well above average. What might traders be thinking here as they're looking down from this lofty peak? Wow. If we're buying right now, we're paying way above average prices compared to where they've been over the last 50 days. And so that may cause some to hesitate. Now, there might be other reasons bringing price down, but as price drifts down, now we're moving closer to average, and now applying that same logic, traders might be looking at this and saying, wow, okay, well, I'm not getting necessarily a short-term bargain, at least from a technical perspective, but at least maybe I'm buying in at or near average prices. That might feel a lot better than buying way above average. And so that may be enough to spur some additional buying behavior, obviously among other influences on the price. But yeah, sometimes that average can act as a price floor, as it did right here, as it did right here, as it did right here. And right here, we might have been expecting it, but it didn't play out. And when price slips below average, if it gets a good distance below that average, maybe some investors or some traders might think, ooh, now I'm getting a real bargain, buying in substantially below average. But as we get closer to the average, that may actually stem the enthusiasm for buying. And that average, instead of acting as support, now acts as resistance. It acts as a price ceiling, and it can contribute to, maybe not necessarily always cause, right? But possibly contribute to new selling. All right. So you can see, boy, over the last 12 months, that 50-day moving average has been a pretty serviceable area of support or resistance. You'll notice coming up in uptrends, it's been a pretty good support. Downtrends, pretty fair resistance with not very many days trading above that in a downward sloping environment. So that is a third way that traders may look for price floors and price ceilings on a stock chart, and you can see how that might contribute to the planning of a stock trade. You can imagine if someone had been planning for a nice bounce off the average here and it broke down through, that may have been a signal sufficient to them to just pull the plug on new trades. Okay, so that's example approach number 3. Now, the fourth approach, this is starting to get into a little bit more niche territory, at least in my experience, but it's still quite common. And that is when there are gaps on charts. They can sometimes be seen as potential areas of support or resistance. So let's have a look at some examples there. Let's look at some of the big companies. Netflix. Let's look back over the history of Netflix. The last 12 months, there have been some big moves overnight on Netflix. When there's a gap in price, it literally means trading closed one day. In most cases, big news came out after trading resumed, or after trading closed, or before trading resumed the next day. But in any case, the price opens either at a substantially higher price than it closed the previous day, or a substantially lower price than it closed the previous day, like we saw here on this earnings announcement back in July. This was a pre-market earnings announcement. Was it pre-market or was it aftermarket? That was an aftermarket announcement. Got investors maybe a little disappointed in the performance of Netflix on that announcement. Price gapped down. And for those of you who do use gaps, or maybe you've studied gaps on charting, what is an assumption with a gap down? What's the initial assumption regarding how price is likely to behave relative to that gap range? Well, when there's a strong gap down, the initial assumption is that traders might be reticent. They might be hesitant to go back up into that gap range. There was some bad news that caused us to gap down here. It might take an offsettingly large amount of good news to cause traders to be willing to get back up to those ranges. Okay. So in this case, we get a gap down. The assumption from here becomes that if price rallies, it may struggle to get above the bottom side of that gap, and you can kind of see that play out for the next several months. And you might be able to envision how that might have influenced the trading for some technical traders of Netflix. Right? You can see that we attempt a rally here and we fade at the bottom side of that gap. We attempt a rally here, we just get right to the bottom side of that gap and fades hard. Now, in this case, it's not always an earnings announcement, but in this case, BJ, yep, gaps can act as support and resistance, right? Exactly the point here. In this case, though, the whole quarter plays out that way until we get to the next earnings announcement. And then we get a strong gap in the other direction. Well, if a downside gap might act as resistance, an upside gap may act as a new support area. Lots of enthusiasm on some apparently big positive news. And in this case, maybe the traders are reluctant to surrender that territory once it's been gained. As long as there isn't some offsetting really negative news, that may incline prices higher. And in this case, you'll see that there was a short rally after the gap. Maybe there was some profit taking by those that made a good amount of money on this upside move. But we only really sagged back down to the top side of the gap before charging higher. And in this case, it doesn't always play out this way, but in this case, it sort of set the pattern until the next earnings announcement. This next earnings announcement, rather than reversing things, just accelerated things. Another strong gap up. The assumption here might be that's likely to be as low as price goes if it ever does. And in this case, it didn't even really challenge that. Just started gapping, just started moving higher. As a matter of fact, there was another smaller gap right there, which acted as a serviceable support level here. There was a gap right there, acted as a pretty serviceable support level, and on we went. And in this case, Scott Scott says, is that an example of an island reversal? Pretty close, Scott. I wouldn't quite call this an island reversal, but it is something that I intended to talk about today. So not really an example of an island reversal down here, not really an example of an island reversal up here. But Scott, good question. But in this case, next earnings announcement, we gap down, and it's not only earnings that can cause gaps, just happens to be with our Netflix example here. We gapped down. There was a strong sell-off even following the gap. See, our gap, the high of that candle was 579. The low of the next day's candle was 542. So there was still $37 of selling here. The rally the next day, where did it peter out? Right at the gap lows. And then we've sold off again. Now, this is interesting. What might be the next obstacle, the next potential support area? Well, if this gap is a resistance area, maybe this gap could still act as a new support. Now, if price breaks down into that gap, what becomes the assumption then? There's kind of an incorrect phrase out there. I've heard the phrase, all gaps fill. It's not true. Nope. If you have a stock that gaps up and goes higher and then never comes back down, that gap never filled, right? Now, it is true that in downward trends, if the stock goes to zero, then any up gap in that downtrend ultimately filled and it was done. But when we enter the gap, we call this the window. So let me just draw this in so you can see what I'm talking about when I'm talking about the window. The window is this blank space between candles, okay? It's the gap. So if we subsequently re-enter that window to a significant amount, the next assumption is that gap may just fill. And we might move down to, in the case of an upside gap breaking into its window, we might close the window, go down. In the case of a downside gap, if we were to sneak back up into it, as a matter of fact, we did. Let me right click here, extend that to the right. Here, you'll notice we broke into this gap window, right? And did we close that gap? Yep. And shortly thereafter, kind of petered out again here. Yeah, here we closed that gap. So yes, if price moves back into a gap range, then the next assumption becomes that the gap is likely to fill. But the initial assumption is the gap should be acting either as support or resistance. Yeah, Speak Truth says all gaps fill sometimes. All right, but let's see. Scott, you asked about an island gap reversal. I don't see this one as an island gap reversal, but I do see this one. Let's look at Meta. Looks almost the same as Netflix, right? We had a gap up. Again, these are earnings announcements that created these, but a gap up followed by a gap down. Here's the difference. An island gap reversal is where we have price moving, and it can be bullish or bearish. In this case, this one's bearish because we have a gap accelerating an upward trend. So we have a bullish gap and price is just going higher. And then we get an offsetting bearish gap that kind of leaves, and here's the key here. Let me remove this drawing. Let me remove this drawing. So you can, and I don't even need the moving average anymore. Let's come up here and just give us a nice clean chart. There we go. But if you look at this group of trading, it's almost as though it's geographically isolated from the trading before and the trading after. I can draw a box around all of that price activity, and it doesn't touch anything else. You see that? So it's not touching this, it's not touching that. The lows are higher than any of the highs before or after. So yeah, this is known as an island gap reversal. This is a bearish island gap reversal because we gap up, sentiment's great, and then we gap down, leaving this stranded group of price up there. And for some traders, they see this as a particularly powerful reversal, and you can probably understand why. We were really bullish, and then we've become effectively, technically, equally bearish. Pretty strong reversal. If we were to see the same behavior, but on a gap down followed by a gap up, we'd call that a bullish island gap reversal. Okay, so if we were to go back to Netflix, it's similar. Let me get my symbol correct in here. It's a Gilligan setup, Speak Truth says. Yeah, I like that better. Let's just clear this whole drawing set so we can focus on just those two gaps. So here are those gaps on Netflix, but if I were to draw a box around our quote unquote island, nope, we still have some trading inside that box. Okay. So Linda, when I use the phrase upside gap, I just mean a gap that took price higher. Okay. Top of the gap is the bottom of the first candle at the top of the gap, right there. Okay. On a downside gap, so that's where price went down, this is the bottom of the gap. It's going to be the top of the first candle after the gap down. Right? So in any case, with gaps, you look at the top of the candle before, bottom of the candle after, that empty space right there. There's the gap window. Here's our gap window here. There we go. Does that help? Visualize that. There's another example right there. There's our gap windows. Good. Okay. Yeah, but that is our fourth technique that is commonly applied to charts. May not be quite as common as just, horizontal or diagonal support and resistance. May not be quite as common as a simple moving average, but still, this is not, earth-shattering, groundbreaking news that I'm bringing to this discussion. This is something that gets discussed in that the field of discipline known as support and resistance. Now, a final technique is commonly applied when the other techniques come up short. So I want to use a couple of examples here. We're going to be using something called a Fibonacci. Bit of a mouthful. An Italian gentleman from way back when, but it's abbreviated to Fibs. But let's go to the chart AVGO again. Let's look at Broadcom again. And here's what I'm talking about. Here's our horizontal, and we're going to have to play. Let me remove this drawing and remove this drawing. What we need to do is imagine ourselves back in time. Let's suppose we were a trader that we were looking at this stock just as we're moving into 2023. And, we had a nice range back here that a trader may have been able to identify areas of support and resistance. Then we got a breakout. We moved above that range. And we might have said, well, using our techniques that we've already learned, maybe our previous price ceiling may act as a new price floor. And that might tell us where support is likely to be. But then our stock really took off. Look at this. We went from $900 to $1,150. There's a $250 move in about a week and a half on Broadcom here. Now, when a stock blasts off like that, it can put it up into a range where a trader's typical approaches to support and resistance might start to break down. There aren't any really substantial gaps here. There's a little one right there. We can't look for horizontal support or horizontal resistance because we're $250 above that price, above those levels. Our moving average is probably going to be way down. As a matter of fact, we could even put it back on here. Didn't mean to click on that. Let's put on our simple moving average again. There we go. We're going to apply that to our chart. You can see here's our stock taking off. And if our trader is waiting for price to come back down to that level, that may just be too far to go. So if everything else is failing us, well, when we get these strong moves to the upside, this is where traders will sometimes recruit a tool known as a Fibonacci retracement to identify potential price floors that are not otherwise obvious and potential price ceilings that are not otherwise obvious. Speak Truth says fibs don't lie. Maybe not, but they can be wrong sometimes, right? So yeah, let's come down here, switch our drawing tool to a Fibonacci tool. Now, if you're not familiar with Fibonacci's, I actually did an in-depth discussion of these quite recently. It's in our archives, in our playlist for the Trader Talks channel. So do this. First of all, make sure that you're subscribed to the Trader Talks channel on YouTube. Just go down and click on the subscribe button right now, or you can go down, click on the one that's down in the lower right-hand corner of my display window at the moment. Yeah, but click on subscribe. It doesn't cost anything, but allows you to get notifications of new webcasts that have been coming out. But you can also, YouTube's the best place to find our playlists, where we take our previous webcasts and organize them by topic and by series. So for example, if you wanted to find previous discussions in this Getting Started with Technical Analysis series, you can come right down here. There's that playlist. And you can just look down through this and say, well, let's see. Cameron said he talked about Fibonacci's. Hey, beginner's guide to using Fibonacci's to trade stocks. Okay. But going back here, when we get a strong move in the direction of an established trend, in this case, it looks like our trend is higher. A technician may come down here, get their Fibonacci, and here's how they draw it on. They'll go to the top of that move, click once, go down to the bottom of that move and click again. And this is going to draw out some lines that are frequently used by Fibonacci traders as potential areas of support and resistance. And specifically, when there's a strong move to the upside, commonly traders will look for a retracement in price going down to somewhere generally around that 61.8 to around the 50 level. If you want to see these explained, the logic of them, go check out that archive that I just showed to you. But in this case, you'll notice price actually sagged down to just between 61.8 and 50. And for some, they might say, good enough. The profit taking has occurred from all of these gains that were made by investors who maybe owned shares of AVGO in the past. Maybe some of those have taken some profits off the table. And maybe a new upward trend, a new upward move is likely to begin. It's not a guarantee, but that might be enough to be actionable. That 61.8 to 50% range is one that's commonly used with those strong moves to the upside. So from here, if that's where support might be, where might the price ceilings be? Where might resistance be? Well, an initial price ceiling might be up here at the top of that strong move, in this case around 1150. And let's just advance. And you can see price got there, and then what did it do? Blasted off. So if traders took profits up here, well, maybe they missed out on these, but they're probably not feeling too bad. From there, what might be the next level? Well, this tool automatically draws in an assumption that's based on a simple extension of what's already occurred. So if price moved up $250 before, and then it retraced, in this case, it pulled back about $100, could it make the same 250 move again? It really just takes this distance here. Let me draw this in. Takes this distance right there and just tacks it on from that 61.8 level and projects up to 161.8. So let's see where that takes us. Did we get there in this case? Not quite. Are we going to get there? Ooh, that's interesting. There we go. Yeah. This level up here may become a more distant price objective or a price target, a potential price ceiling that's not otherwise obvious on the chart. You know, back here in January, there wasn't a price history to look to give us a gauge that maybe prices might ultimately get to $1,300. In this case, price actually did get to that level, but it doesn't always work out that way. That's just the way that a Fibonacci trader may set their price objectives. An initial objective to get to the 100, and next, if they're shooting for it, maybe the 161.8. Okay, but we do have time. Let's maybe look at a couple more examples here. Let's go to Microsoft and see, are there times, yeah, when Microsoft really blasted off? Here's one of those cases. Took off, it got above traditional areas of support and resistance. There was a strong move right there. This is interesting. When it pulled back, where did it get down to? 61.8. Then rallied back up to the 100. Where was the next area that it reached? 161.8. So that's an example of bullish moves. What about bearish? Well, this is starting to break down again. Made a strong move to the downside. You'll notice here from this peak April 11th until maybe April 22nd, it ran down. We could use the same tool, just make a click at the bottom and make our second click up the top, and it makes the same lines, but in the other direction. And interestingly, after this strong sell-off, where did our rally start to falter? Right at that 50% level. And then we've come down, we actually reached the 100%, could go lower from here. Time will tell. But a Fibonacci tool was our fifth and final tool that I wanted to introduce for the potential identification of support and resistance levels that sometimes traders will use when it's not otherwise apparent using those other techniques. So, guys, we've accomplished what I set out to do. We talked about support and resistance just as a concept. We talked through 5 different ways that they might be identified on a chart, and we looked through a series of example charts to connect theory with application. Hope you enjoyed that discussion. Time to wrap it up. I'm going to let you go, but as you go, just remember a couple of other resources that you need to take advantage of. Number one is to follow Lee and me on Twitter. So you can follow us there at Lee Bull CS. You can follow me at Cameron May CS. But this really is the best place to connect with your favorite presenters in between these webcasts. The other thing to do, if you haven't done it yet, is to go down, click on the subscribe button. Let's go back here to our Trader Talks channel. You don't have to come to the YouTube Trader Talks channel homepage. You can just go down, click on subscribe right now. Doesn't cost anything, but allows you to get notifications when new webcasts come out. And yes, you can find our playlist. You can also join the live streams here. So a great resource. We provide all this at no cost, and it helps our channel. It helps our reach in these media platforms. So might as well, right? Speak truth. You say great job plowing through the 5 concepts. Well, I hope you enjoyed that. This is what we do on Tuesday afternoons. So if you want to put it in your calendar to join me each Tuesday, I'd love to have you here for getting started with technical analysis. Of course, I have other webcasts Monday and Wednesday as well, sometimes on a fill-in basis on Thursday or Friday. But I'd love to see you in those webcasts. we'll be looking for you also on Twitter or X. But guys, whenever I see you again, I do want to wish you good luck, but also thank you for how many people? We have 125 people watching live. 47 have already clicked the like button. Thank you for doing that. That's very much appreciated. If you'll click that like button, that sounds like applause to me. It also helps our channel out. So that's a double win. And even if you're watching on the archive, click the like button. It helps. But everybody, yeah, we'll look for you in a future webcast. We'll look for you on X. But whenever we see you again, until that moment arrives, we want to wish you the very best of luck. Happy trading. Bye-bye.